In this video, we are going to talk about determinants of interest rates. Some of the interest rate fundamentals. Nominal interest rates are the interest rates actually observed in financial markets. These are the actual quoted rates. When you go look at interest rates, that's the number you see. However, that number, it's a composition of a variety of different premiums that get added up in order to arrive to that interest rate that you see. Now, the interest rate that you see in the market directly affect the value of most securities traded in the money and capital markets. The typical example we use is bonds. The interest rates out there will affect the price of bonds, but pretty much everything else gets affected. That's why when you hear in the news about the Fed moving the interest rates up or down, pretty much everything is affected by it. Changes in interest rates influence the performance and decision making for individual investors, businesses, and government units. This also has an international impact, especially the United States, because it's such a large economy with so much intertwined in the global economy that anything that happens here, everybody's watching and things get adjusted accordingly. So when we talk about loanable funds theory, generally speaking, it's supply and demand. Now, the financial institutions and in the financial market as well, there is a lot of attention being paid on how interest rates move and what are the expected movements in the future, because as we mentioned, everything gets impacted by it. And changes in interest rates has an effect on the supply of money also and the demand for money. So that right there is also a way that affects everything else because it pretty much affects how money is going to circulate. So in the second paragraph here, loanable funds theory views equilibrium interest rates in financial markets as a result of the supply of and demand for loanable funds. So you can view it at the macro level, like the overarching as a supply and demand issue, and then everything else follows where it's impacted by it. Your good old fashioned supply and demand graph. Uh, when we look at it here, we have the interest rates here on the y axis and the quantity of loanable funds supplied and demanded on the x axis. So when interest rates are low, the demand is going to be high because it's what we call cheap money. However, because the interest rates are low, not many people are going to supply it because there's not much money to be made by lending money. So when that happens, then the natural course of action is going to happen. The interest rates are going up. There's a lot of people that want it, not many people supplying it, so they can start charging more interest because there's a lot of demand out there. But as those interest rates go up, more suppliers jump in, or the same suppliers provide more funds to lend out because there's more money to be made. But more gets supplied, period, until they hit this equilibrium. Now, what may happen is that there's an overshot of the suppliers. So now, because as people are trying to make more money, then the interest rate has to come down to meet the equilibrium again. Now, let's say there's a government intervention like monetary policy where the Fed increases the rates. So yeah, more suppliers come in, but it's going to start bringing demand down because the interest rates are getting higher. And then that's that dance that keeps on happening until you hit that equilibrium. Now, we're going to start talking about the things that build that nominal rate that you see in the market. So, one thing that is important and is always in play, and one of the first things that is looked at is inflation. And one of the reasons is the first thing to look at because that this applies to everything. The other determinants we're going to talk about may or may not apply depending on the security that we're analyzing or evaluating. However, inflation is universal to everybody. So, as you know, inflation is the continual increase in the price level of a basket of goods and services. The higher the level of actual expected inflation, the higher will be the level of interest rates. So, whatever percentage that inflation is going to be built in those nominal interest rates that you see in the market and is typically done through consumer price index. It's what's typically used to calculate inflation. Now you will see there's always a lot of other ways to calculate inflation, but we're talking about the basics here, and this is a good starting point to understand how inflation works. Now let's talk about what is known as the real risk-free rate, not to be confused with the risk-free rate. There's the risk-free rate, and then there's the real risk-free rate. The difference is the real risk-free rate, think of it as the starting point, the baseline. Everything starts from there. The real risk-free rate is the interest rate that would exist on a risk-free security with no inflation. So you really never going to see this unless inflation is at zero, or if there's disinflation or some kind of contraction of inflation is going backwards. But typically there is inflation. That's your normal state. So what you do is you take the real risk-free rate, and then you can add the inflation rate, and then you end up with the risk-free rate, the one without the word real in front of it. One way to get that number, it's they call it the Fisher effect. Now, I want to clarify something here. This formula at the bottom, the Fisher effect is often written as the following: the real risk-free rate plus the inflation that we spoke just now. However, this here is an approximation. This is not the actual Fisher effect formula. This works for a quick estimate. We will discuss Fisher effect, the actual formula later. It's not too complex. It's just a little different than what you've seen here because it has an adjustment. But get familiar that real risk-free rate, the first thing you want to do is add the inflation rate to it to start getting to these nominal rates that you will see. So the federal government bonds are typically calculated in this fashion, the interest rate. They take the real risk-free plus the inflation, and that's what you get because it's a risk-free security. Remember, the federal bonds are guaranteed by the federal government. So you will get the money. So it's considered risk-free. You add inflation, and that's the rate you get for those bonds. I should add to this federal bond comment that when you just add the real risk-free rate plus inflation rate, you get the risk-free rate of the government bond. At that point, those are the short-term bonds. We will talk about how long-term bonds may have maturity risk with it. So that comment of real risk-free plus inflation, think of short-term less than a year. Default risk is exactly what it sounds like. The risk of the person that borrowed the money not being able to pay. So, for example, we just spoke about the federal bonds that are guaranteed by the government. So those do not have default risk because they will make that payment. Even if they had to print more money, print on quotes, of course. We don't literally print money anymore in that sense, but you will get paid. So default risk for federal bonds is not a thing. This will be more for like a company. So if a corporation is issuing bonds, there's always a chance that they cannot make the payment if they don't have the cash. So the more solid the company is, the well established companies have lower default risks. A company that is not in good ground will have higher default risk. So they have to pay more for borrowing. So this kind of works similar to people with good credit score versus bad credit scores. If they have a bad credit score, the risk of default is higher. So the lender will charge a higher interest rate on the loan. So same applies here. Bonds are just a debt instrument. They are a form of borrowing, and default risk it applies. Liquidity risk. Back to the federal bonds. They do not really have liquidity risk in the sense because they're easy to buy and sell. There's a lot of markets for it, but not all bonds are easy to buy and sell. So the less of a market there is for it, then the harder it is to sell it when you want to. So if you have, if there's a high risk of liquidity, meaning that will be hard to sell, then they have to offer a little more interest. So that premium has to be included in the price of that nominal quote you will see eventually. Again, federal bonds are highly liquid, so they typically don't have liquidity risk. Another thing to consider on how that nominal rate will become the number becomes is, are there any special conditions to the loan or the bond? For example, special provisions or covenants that may be written into the contract under line of security also affect the interest rates on different securities. Now, I know I'm continue using bonds because they're a little easier to understand, is the one that is affected the most by these premiums. And but understand that it's not just bonds. It's just a good way to illustrate the situation. So some of these provisions include the security taxability. For example, municipal bonds, those are known as munis. Those are state level and below. So these are, I'm not talking about federal. They're government bonds, but they're not federal. They have their state, county, city, that type of bond. Those have a tax break. So because there's a tax benefit to it, then that may impact the rate. They may on the nominal rate, it may appear that they're paying a little less interest. However, because there's a tax benefit, you might actually end up with more money. So that's something to consider on the taxability. Convertibility. Some bonds, for example, and there's just one example, the corporation issuing a bond may have a stipulation say that at any given time they can change the bond into stocks so they can convert them. Now, this has an impact on your investment strategy. So they will have to compensate you for this, for them holding that right. They might have to compensate you. You may demand a little more interest rate on it. Callability, that's when a corporation it's similar to accelerating the loan, where they can say, here's your money, give me the bond back. So they can buy it back from you when they choose to, and you have to sell it. Because now they have that right, or reserve that right to do that. They may have to compensate you accordingly as well. For investors, interest payments on municipal securities are free of federal, state, and local taxes. That's what I mentioned a moment ago. This is the convertible part. We already explained that. The next bullet is that. In general, special provisions that provide benefits to the security holder are associated with lower interest rates. So if it's a benefit to the security holder, you may expect a lower interest rate. And by security holder, the investor, the one that buys the bond. Now, if it's a benefit to the corporation issuing the bond, then you should expect a little higher interest rate for the investor. Convertibility here, they have it under Security holder benefit, it may or may not, because if when you looking at your overall investment strategy, if you wanted a bond, a certain percentage of bonds in your portfolio at that interest rate with that volatility, and they switch you to equity, then it just moved and you may want to have to offload it. So then it's not beneficial for you. So convertible may or may not be beneficial because stocks and shares come with higher risk. It may be higher return, but it may not be beneficial according to your investment strategy. So that can go either way. Now we're going to talk about maturity. The most basic way to explain this is the future is unpredictable. However, it's easier to make a guess of what's going to happen a month from now than to make a guess of what's going to happen 20 years from now. So the longer the maturity of a bond, for example, the more risk there is to things that can change and go in all kinds of different directions. So the longer the maturity of the bond, and assuming all things are normal situation, and it's because I don't want to get into the whole yield curve conversation right now, assuming everything's under normal situation, then the longer the maturity of the bond, you would expect a little higher interest rate. And it's because it becomes more and more unpredictable the more the maturity to the bond. Now we're going to talk about a few of the different theories that people operate under. Now, there's pros and cons of supporting evidence for and against these theories. And at the end of the day, it depends of who and when and where, etc. So here are the some of the key ones, these three. Unbiased expectations theory. Uh, in a nutshell, what they're saying is that if you buy a bond that matures in 5 years, your return on your investment should be the same as every year for the next 5 years you buy a 1 year bond. And it's because the expectation of the market in 5 years will be adjusting year by year to where you end up with the same. Now, we're not going to get into reinvestment rate risk and other types of risk of that sense. However, the big caveat is this here at the end, which says as long as the market is in equilibrium. So sure, as long as everything is well balanced and everything like that, this could easily average out to the same. You may have, but there's so many other things that happen that could throw the market off equilibrium temporarily. The market always gravitates towards equilibrium, but there's shocks that happen all the time and things that shake. A war breaks out and it changes a lot of things. Just too many things that can impact this. Now, in the very long term, you're talking about 10, 20, 30 years, then it's more likely to average out in this sense. But it's easy to punch holes on this one because at any given time, something can happen. A new innovation technology changes the equilibrium. So one thing is, as long as the market's in equilibrium and the equilibrium is there, but also, like I said, there could be shocks to it, shifting it off equilibrium, or the equilibrium point changes position because of, let's say, a technology advance. So there's a lot of things that can happen to throw this off. But under normal circumstances and no changes, what we like to say ceteris paribus, then sure, this would apply. Liquidity premium theory. This is tied up with the maturity, the liquidity and the maturity thing we spoke about. Bottom line is, as I said, the longer the maturity, liquidity goes down. Therefore, you should expect higher compensation. Market segmentation theory. Okay, so I'm going to read this. Assumes that investors do not consider securities with different maturities as perfect substitutes. This is kind of in a different direction from what we saw in the unbiased expectation theory. So you cannot say 1 year versus 5 years and all that. And this actually banks and corporations uses a lot. Banks cannot compare long-term and short-term or even 5-year bonds with 20-year bonds and all that. They have to separate these. And this would be a practice that applies to what we call enterprise risk management, something we spoke earlier in this course. And it's important to not conflate the different maturity securities. Another thing too, in the corporation side, the borrower side, that's on the lender side, what I just spoke about. The borrower side is there's this rule of thumb. And there's good reasons for us and rule of thumb to avoid having to get a deep explanation, but long-term assets should be financed with long-term liabilities. So therefore, if you have a 30-year asset, you should use 20-30-year bonds as your if you're going to finance it that way. And short term with short term. So that's kind of like what they're talking about here. So to add a little more detail to these theories, we'll start with the base case, which is the unbiased expectation theory. And these are the formula that will be used for that type of of approach. Please refer to example exercises in the textbook and the homework in order to practice how to apply this formula. So that's like a starting point. So what happens is when we then go into liquidity premium theory, one way to look at it as it being an extension of the unbiased expectation theory. Now, the extension part is that the unbiased expectation theory assumes that investors are risk neutral. That in the finance world, it's a big assumption, but it's a starting point. We also start somewhere. So liquidity premium theory is an extension of the unbiased expectation theory based on the idea that investors will hold long-term maturities only if they are offered at a premium to compensate for future uncertainty. Now, remember, in the unbiased, there was no difference between getting a 5-year bond or getting 1-year bonds 5 years in a row. Here they're saying, no, if I'm going to commit to the 5 years, I want a little extra that I would get if I did 1-year bonds 5 years in a row. And it's because once you get out of the bond in the first year, it frees up your capital, reinvestment rate risk or interest rate risk applies. So this is pretty much saying like, yeah, that's all fine. But if you want to make the long-term commitment, I need a little extra. Then if not, I'll just do it one at a time. If it's all the same, why add the risk? Market segmentation theory argues that individual investors have specific maturity preferences. So by preference could be a personal preference, or as I mentioned, it depends on what you're doing, what's your strategy at the time. It could be, as I mentioned, long-term assets being financed by long-term debt, or that if it's just a portfolio that you're diversifying or balancing out in some fashion to reach certain level of risk and return, then you will have a preference of maturity that is not based on the risk of the asset itself, but how it fits on your investment portfolio or assets. So that's one thing to consider, that there may be other factors at play that impact your preference. And as always in finance, we will never escape time value of money. As you have or should have already heard many times before, $1 today is worth more than $1 tomorrow. And the same time value of money, present value calculations apply, present value, future value, the value of an annuity, etc. The two key ones are number one and number two here, value of a lump sum versus value of annuity payments. The lottery is always the one that everybody understands. If you win the lottery, they can say, here's a chunk of money up front, but it's going to be less than the prize. Or we can give you the prize money, but it's going to be broken down over, let's say, 20 years and annual payments of so much. So that's what they're doing in the lottery payments. They're doing a time value of money calculation. This is just a refreshing reminder of the future value and present value calculations. Present value and future value is just algebra in the sense that let's look at future value. It's present value times 1 plus the rate raised at the time. And if you want to get present value, all you do is move this and divide it by that, and that's how you get this one. So that's always the basic formula. Everything else is just added to calculate other values, but this is always a starting point. I strongly suggest you reacquaint yourself to the financial calculator to make your life a lot easier to get these calculations. As we mentioned, annuity valuation, it's the payments approach. Instead of getting a lump sum in the future and calculating the present value without any payments in between. But if you are going to change payments into future value or present value, you have to do a little modification so the payments are in the formula. Okay, again, you can do this with this formula by hand, but your financial calculator will make your life a lot easier. And that's it for this lecture. See you on the next video.